What Warren Buffett taught me about buying businesses. So the first thing that Warren Buffett taught me about buying businesses is the same as Charlie Munger. Keep a cool mind when you're making investment decisions. When you're buying a business, it's ultimately an investment decision as much as it is a business decision. And you need to make sure that you're making it from a cool mind. You're not getting too emotionally attached to the investment decision. One of the best ways that I like to regulate my feelings regarding a business is to really have someone on my team who plays devil's advocate and argues against the business acquisition that I'm going to do. And therefore, it makes me step back and think, is this really a great opportunity? Is it really something that is going to provide long-term value over the course of the life of this business? And that's the other thing that Warren Buffett talks about, is that go for the opportunities which are great businesses over a long period of time. So what Warren Buffett and Charlie Munger both talk about is that those businesses opportunities, they don't come about every single day. The great businesses, they may only come about once every 5 to 10 years. So when they do come, you identify them, you pounce on them, and you go all in and you go and buy that business, even if you have to pay a little bit of a premium to get that business because they're so rare that they end up on the marketplace or come onto your desk that as a business acquisition opportunity. And that's the other thing, is that when those great businesses do come about, is that go all in, but also think that I want to own this forever. Because even if you want to exit the business one day, which most people who buy businesses do want to do, it's really important. You may change your mind. You may say, you know what, I don't want to sell this business. I want to own this forever. So if I do want to own it forever, then is it going to be able to provide me an income over a long period of time? And even if you do want to exit, the reason why you want to buy a business which is great over the long term is because, and I'm going to talk about in a minute what Warren Buffett says, a good business over a long period of time, is that when you're selling the business, the potential acquirer of the business to you needs to see a future in that business, needs to see that this business is going to provide value. So therefore, you need to look for that now, even if you're going to exit that in the future, because this is going to provide long-term value way past that you're going to own it. And when you sell it to that person who's going to buy it from you, you're going to sell it as a premium, at a premium, on that very basis that it's going to provide long-term value. And one of the other things that Warren Buffett says is say no quickly, because if a business is not a great business for the long term and it's not a great business and doesn't provide great value in the marketplace, then move on and say no. Why? Because there are always going to be businesses which do meet your criteria. And that's something that I always talk about with my clients, is that have a very strict criteria. Few things which are extremely strict. I call them the non-negotiables. So have some non-negotiable criteria. If it doesn't meet that, just move on. Say no, thank you very much. Saves you so much energy and brain time to go and analyze acquisitions that just don't fit the bill. The other thing that Warren Buffett talks about is to really understand the business. Understand the business on two levels. Number one, understand the product or service that it sells into the marketplace. Whether that's to a consumer or to another business, is this something that I understand? Because if I understand it, it's within my area of competence, it's within my circle of competence. And therefore, I see the value that it provides. And that's why he's a big proponent of value investing. That's how I adapted the name to value acquisitions. If you can identify the value that it provides to the marketplace, then that will be a good business opportunity to go and buy. And the same way is that, does the business operate under sound, solid fundamentals? So what does Warren Buffett say? What are the fundamentals of a business? Number one, the product or service that it provides is a strong product or service which has a moat around it, meaning that it's very difficult for the consumer or whoever the customer is of that business to go to another business to buy the same product or a similar product. They are always going to come back to you. The best example of that is Apple. So Apple, and even Android to a certain extent, but Apple specifically, once you buy an iPhone, then it's extremely difficult for you to move off the iPhone because you're so used to the iOS software. And you like the product, you love the product, and you're going to continue to buy iPhone again and again and again. Even if they make hardly no changes in the new model, when your one gets old and you decide that you want to buy a new phone, you're always going to go for an iPhone. So that's why the fundamentals of Apple is great. And Warren Buffett is a big investor in Apple. Of course, he sold some of his shareholdings recently, but still a very, very big investor within Apple. How does that apply to local businesses, small to medium-sized businesses? Is that in a local place, is that will that customer only ever go to that business and not to any other business? Best examples are restaurants. So in a local area, there might be an Indian restaurant or a Chinese restaurant or an Italian restaurant that everyone goes to because it's fantastic. Now, there may be a new Indian restaurant that opens up locally, maybe a new Chinese place, a new whatever place opens up locally, but they might try it, but they always have this affinity to the original restaurants in the local area. So they have their moats. It's very difficult for other businesses to come in and penetrate the marketplace because the customer has that affinity to that business. The next thing that Warren Buffett talks about is to focus on net earnings. So, of course, all of the fundamentals of the business, meaning revenue, gross profit, and earnings. But he says instead of looking at operating earnings, look at net earnings, because that's ultimately what will be returned to you as a business buyer, as a investor. So when people look at company valuations are normally done on a multiple of EBITDA. There are other ways to value a business, but that's the most common. What Warren Buffett says is that, okay, that's fantastic. You can do your valuations on EBITDA, but what I'm focusing on is net earnings. What is this thing going to return to me? And hand in hand, what that goes with is that focus on the debt service cover ratio. Now, he doesn't talk about debt service cover ratio, but I talk about debt service cover ratio. What he talks about is focus on debt to earnings, because ultimately, when you're buying a business, you're buying it with cash, either from yourself, or when I say yourself, I mean either from you as a personal person, which I advise never to do, either from your business because you got retained earnings, which you can do, or from investors or from lenders. Now, when you are getting money from investors and you're getting money from lenders, or you're putting in retained earnings into a business acquisition, you need to forecast is that how is this going to be paid back to you, and is there going to be enough profit left over after those returns are paid back to investors, those returns are paid back to lenders, those returns are paid back to yourself as the investor. Is there enough margin of safety that the business can continue to run and have great working capital to continue to invest in the areas that it needs to invest in to continue operating? So focusing on net earnings and debt to earnings, meaning debt service cover ratio, and having that margin of safety is extremely important. And that's why when I'm advising people on their business acquisitions, I always talk about stress testing any forecast that you do. And also, just like Charlie Munger, Warren Buffett says completely ignore professional forecasts. So if a business broker, an accountant, the business owner that you're going to buy the business from provides you with forecast, just get them and throw them in the bin. Don't even look at them. Seriously, don't look at them, because they're going to skew your mind into what can be done. They're always going to show this picture of the business like it's having its best year ever. If you look at the previous history of the business, it's not even produced in some cases. When I used to look at forecasts, some of these forecasts used to be double what the business had ever produced previously. And they say, yeah, because the business is doing this, the business is doing that, that's why it's going to be double next year. And when I started listening to Warren Buffett and Charlie Munger, they're like, completely ignore forecasts. It was the best thing that I ever did, because we produce our own forecasts based on debt service cover ratio and margin of safety, and we stress test it, and we get fantastic results. We're always very conservative and advise you to do the same. The next thing is to focus on fair prices for businesses. What that means is that buy wonderful businesses for fair prices. That's his and Charlie Munger saying. But also what Warren Buffett says is that don't buy a business just because it's cheap. This is one of the rookie mistakes that a business acquirer can make when they first start out buying businesses. So you could look at a business, and that's the problem, is that most business acquirers don't know when they're being fooled into looking at the incorrect metrics. Because remember, a business could be one thing before it's been sold, it could be a completely different thing after it's been sold. Now in this video I'm talking about what Warren Buffett has taught me about business acquisitions, but I'm sure there's videos on the other channel which talk about this, and of course I go through this in detail with my clients. That a business may be portraying some numbers right now, but is it going to be the same after the acquisition? Just because there may be a cheap valuation attached to it right now, don't be fooled in buying that business because you think, oh, that's really cheap based on what it's producing right now, because it may be a completely different situation after you own the business. So you need to focus on fair prices based on the post-acquisition environment. You need to base your valuations on fair prices in comparison to the post-acquisition environment of that business. And of course, there are many things that Warren Buffett talks about, and he's got hours and hours of content through his annual meetings. You can watch all of them. Of course, it's going to take you days and weeks, months even. I've gone through all of them and read so many articles, a lot of his letters that he wrote to shareholders and so on. And they all teach you everything. But I've distilled that down because don't forget, he's buying multi-billion-dollar businesses, multi-million-dollar businesses when he started off, of course, but now he's buying multi-billion-dollar investments. I've distilled that down into a value acquisition to the small to medium-sized marketplace and how you can use Charlie Munger, Peter Lynch, Warren Buffett, and Bill Ackman's principles and buy an acquisition. So if you want to find out more about value acquisitions, watch this video which is popping up on the screen right now. And of course, there's a link in the description which you can go to the full training on the value acquisition.